Hello, welcome back to today's video. So we'll be going through episode 2 of what we had just started, and right now I want to go through the book which we had just started reading, Getting Started in Forex, FXDD. I placed the link in the video descriptions of the previous ones, and well, in episode 2 we are going on to move from page 10 to the last page, that is page 21. So hold on and keep in touch. Welcome back. So last time we had gone through a few things. I'll just brief you through them, and here, well, I had some notes here. You can just look at them. Yep, mastering the skill. This was the first part, the introduction part. We did chart analysis techniques. We were supposed to have good picture of market long term, medium term, and short term movement. Identify trend of market, that is strength of each of them. Identify important candlestick patterns information, and identify strong support and resistance levels that can help you in your entry and exit. At the end of the course, students should be able to read chart like the author and have a better understanding of the market movement and eventually win more trades. So we started with what is forex. Forex is basically foreign exchange. It's a short form of those two words, and we went through buy and sell. We saw that if you buy a currency pair, you're expecting it to increase in value, that is, you are going long. And if you sell the currency pair, you are expecting it to decrease in value, and thus you are going short. So reasons for trading, there are two reasons for trading, that is speculation and conversion. So you may trade just to speculate the movement of the currency pairs to get profits. That's what most traders do. And you may trade to convert your money from one currency to another. That mostly happens with the tourists or maybe big companies that trade internationally. Yeah. So there are currency pairs whereby we have this part. The first part is the base currency, and then the second part is the quote currency. They are separated by a backslash, and therefore you may find currency pairs like Euro USD, Japanese Yen USD. Yeah, such stuff. Buying a currency pair is similar to buying the base currency while simultaneously shorting the quote currency. Selling short, at first we say that shorting is like selling. So selling short a currency pair is same as selling short a base currency while simultaneously buying the quote currency. So what you do it to the base currency, but do the opposite of the quote currency. Then on the currency pairs, this was the example that we looked at. So if you buy the euro for a euro USD, if you buy the euro, then you sell the USD. If you sell the euro, then you buy the USD. And if you sell the euro, you are expecting it to decrease in value. Yes. And the second part we did, we went to commodity pairs. And commodity pairs, here we say that there are some commodities that go hand in hand with the same trajectory as some currency pairs. Here we say that things like gold or oil may move relative to some currency pairs. For example, the Australian dollar / USD moves in the same trajectory as the gold, and USD CAD pair, USD and the Canadian dollar pair moves in the same trajectory as the price of oil. And then we went on ahead to look at pips, where we say these are primary units of movement for all currency pair exchange rates. And pips are divided into, pips, is what we went through. So for example, this is a pip, and then this lower here, this is a 4, this is a fractional pip. Just a moment, let me show you what that is. So 1.2001 and let's call it a 4 cent, yeah, because that's a fraction. 0.4, let's just say 4. So this is 1 pip. So if it moves from 1.2001 to 1.2005, if this one changes to 5 and these ones retain their value, it means that it has moved up with 4 pips. Yeah, I guess that's understood. And then we went ahead to look at lots, and then we said that lots represent a fixed amount of currency. And after saying that, we say that 1 pip is 100th of a cent, and 1 lot is 100,000 units. 1 lot is equal to 100,000 units. So we say that 1 lot is 100,000 units of the currency you are trading. So for example here, if we are buying one standard lot, then we are buying 100,000 USDs. And so let's say that we are trading the Euro USD, and then we say that if you open at 1.2401 and you are buying, then you close at 1.7631, that is that will have moved by some units up. Then what we said is that if you had that 1 lot and then you convert at your opening, you'll find that you started with 124,010 USDs, and then you close at 176,310 USD. So therefore you'll have made a profit of 53,300 USD. And with the same scenario, we looked at another example whereby we were opening at 1.2401 and closing at 1.0001 while buying. So you buy at an opening of 1.2401 of a standard lot size and close at 1.0001. And then with that, we saw that you opened at 124,000 USDs and closed at 100,000 USDs, therefore making a loss of 24,000. So by looking at the movement of the charts, you can know whether you make a profit or not. So let's go on to what we'll be going through today. Yeah, so this is what we had done the previous day, and now we are moving to margin and leverage. And I'll just do what we did last time. I'll open chart. Let me close these tabs in just a moment. Let me close all these tabs and then open chart GPT and Investopedia at the side. Then we see what we'll do today. Well, good luck in the lesson, and keep in touch, keep focused, and let's keep it going. We must know this. You must learn this together with me. And I'll be happy if we complete the challenge together and see how fast we can learn this and practice and start real trading. Well, welcome, be my guest. Oh, and today I have this mic here. Today I just got this mic. Yeah, this one here. And I'll be using it, so let me just connect it to the camera in just a moment. Just a moment. I hope I'm still visible in the background. Yep, that's it, done. So let's start. Margin and leverage. They say traders and brokers are only exposed to the change in market value on open positions. Yeah, that's true. You are only exposed to it when you are opening. The change in value of most currency pairs move about $1 a day. In fact, in 2011, the average value change for the Euro USD per day was $1.57. The USD Japanese yen pair average value change was only $0.88. That's not much. As a result, the retail traders are given leverage on open positions. So basically what's happening here is that they say the movement of the currency pairs is not that great and therefore this not being so much, traders cannot make very great profits. So therefore there's need for leverage. In a moment we'll know what leverage means and margin. So let's go on. They say leverage allows traders to control large positions with a lower amount of funds. That can be good, but can also be bad. Leverage amplifies your gains as well as your losses. So it's like you're being loaned something. You are being loaned some part of money so that you make big trades, while you can make big losses or big profits because you are trading on leverage. You are leveraged some money. Average USD value of daily range in 2011. That's a table which shows in 2011 how the values changed averagely per day. Yeah, so we can see the one which moved so fast or so greatly was the Euro USD at $1.57 a day, but that's not much big. Let's go on to the next part. Let's look at an example of the effects of leverage. Mary deposits $10,000 USD in her account at FXDD. She's encouraged by a strong US employment report to buy the US dollar. Since she feels the Japanese yen is too high, she buys USD JPY with the expectation that USD will appreciate against Japanese yen. So she feels Japanese yen is too high, and now she thinks since it's too high, the USD will rise against the JPY. Remember, JPY will depreciate relatively as USD rises. Mary buys a standard lot. A notional amount of $100,000 of USD JPY at a rate of 79.50. Don't mind, that's a plane passing. Mary buys a standard lot, a notional amount of $100,000 of USD at a rate of 79.50. See next page figure. So let's go and see the figure. Oh yeah, we'll move on to that. And so let's go back to this part and continue. Just a moment. So for a moment I was gone a little bit, but let's go on. So we were saying that Mary buys one standard lot, a notional amount of 100,000 USD of USD JPY at a rate of 79.5, and we've been referred to a figure. This one's figure 1. This is it. So she buys it at this part. So let's go on. So we see she buy at 100,000 USD at 79.50 USD JPY. That converts to 7.95 million JPY. Okay, paid on buy. So let's go back and see if we understand that. So to control that position, Mary needs to post margin from the USD 10,000 of available funds. So we had first seen that Mary had 10,000 in her account. So with 50-to-1 leverage, that's the ratio of which she's leveraging at. Mary need only pledge 2,000 as margin on a 100,000 USD position. So let's see if we can see what that means in calculation. I have not written anything yet, so just a moment. Let me place the camera well. Okay, so leveraging and margins. Yep. So Mary has 10,000 USD and she wants to leverage. She leverages at 50-to-1 ratio for a standard lot. And as before we had seen that a standard lot is 100,000 units of the base currency, which in our case here is the USD. So 100,000 USD. So she's leveraging at a ratio of 50:1. So now let's see how much she needs. So you'll say that if 50 is 1, if 50, this is just basic maths, if 50 is 100,000, how much will she need for one unit? Because that's what she is leveraging at. That's the ratio that she'll be using. So how much will she need to represent this 100,000 units? So she'll need 1/50 of that 100,000, which is in our case $2,000. So she'll use $2,000 USD for a position. So she'll use 2,000 USD for a position of 100,000. So with 50:1 leverage, Mary need only pledge 2,000 USD as margin on a USD 100,000 position. So she'll use 2,000 as a margin on a 100,000 USD position. So she'll only spend 2,000 of the 10,000 she had to trade with a position of $100,000. I hope that's clear. Moreover, since there is 8,000 US dollars of unplayed funds, she had 10,000 of first, so she has 8,000 more, which is unplayed. Mary has room to take an even larger position if she so desires. Yeah, so now we've understood the part of leveraging and margin. Let's assume Mary is correct. She bought, right? And when you buy, you expect it to go. You expect the base to go up, while here our base is the USD and our quote is the JPY. So she expects the base to go higher and the JPY to go lower. Let's assume Mary is correct, and the USD JPY price moves higher from 79.50 to 80.00. So at 80.00, Mary is content with her gain, and she takes her profit by selling an equal one standard lot of USD JPY. So she now sells it after being content. She predicted that at 79.50 it would go higher, and now it has reached 80.00, and now she's content. So now she sells it, and she takes her profit by selling an equal one standard lot. You remember she held a one standard lot position. So now she sells an equal one standard lot at this price, 80.00. So now let's look at how leverage helped her. Okay, so this figure 1 we had gone through this, and this figure 2 now we are going through this. This is the figure 1 that we had gone through. Let me just zoom. Yeah, that's figure 1, and now this is figure 2. Yeah. So now at 100 for the leverage that she had, remember she only used 2,000 for this to hold a position of one lot, which was 100,000. Therefore, she at 79.50, we can say that she paid 7.95 million Japanese yen, and then at selling that one standard lot position at 80 USD/JPY, she sold it at 8 million. Thereby, if you take that difference, 8 million and 7.95 million, you find that she made a profit of 50,000 JPY. That was her profit. But now this is in Japanese yen. So now, since Mary's FXDD account is in USD, JPY profit needs to be converted into USD at the current USD JPY exchange rate, which in this example for our case it's 80, because now she's selling it at 80. The profit is at 80, right? When she sold it, that's when now we are calculating the profits. So she needs to exchange it back to US dollars from Japanese yen, and therefore her profit from Japanese yen 50,000 would equal, so you take the profit, then you divide by the exchange rate, which in our case is 50,000 Japanese yen divided by 80.00 Japanese USD exchange rate. So by doing that, let me just get my calculator. Yeah, and then now from my calculator, 123 divided by 80, that gives you 625. So profit of, let's write that down. So profit of 123 JPY at sell of 80.00 gives 625 USD profit. Let me just write profit. Yep. So just by that, so I could also write here just for memory, about 79.50 sold 80.00 profit on standard lot would be 50,000 JPY, which is 620. Okay, let me just 625 USD. Yeah, that's quite understood now. So moving on downwards, the return on investment gives a trader an idea of how much they made or lost. So this is the return on investment. Oh, apologies for that. The ROI, return on investment or margin, gives a trader an idea of how much they made or lost a trade in terms of the ROI or margin applied. In our example, we know Mary played 2,000 of margin to her USD trade and made profit of 625 US dollars. To calculate her return on investment, divide the profit by the margin. So her return, okay, so her margin was 2,000 and she got a return which is a profit of $625. So dividing that, the profit by the margin, will get that she had a return on investment of 31.25. So let me just write that down. ROI is equal to profit slash margin. So in our case, that is 625 over 2,000, which is 31.25%. So we'd say that this 2,000 here is the margin. Let me use a different pen. Is the margin. Yep, that way. Moving on to the next thing. Let's see. Calculate her ROI. Divide the profit by the margin. Okay, that's good. Okay, just something else that's important here. Let me just enlarge that and show you this part. So let's keep in mind that if the market was to move against Mary's position, she would have lost funds. For example, if Mary bought one standard lot and the price moved 50 points in the opposite direction from 79.5 to 79, she would have lost $632.91. So we can just do simple calculation of that and see if we got it right. So it means that if the markets were to move against her, then with the standard lot at 79.50, a standard lot she would have invested 7.95 million. Okay, 7.95 million JPY. Then if it reduced by if it moved 50 points down in the opposite direction, then that means that she would have sold it at 7.9 million. 1 2 3, making a loss of 50. 1 2 3, making a loss of 50,000 JPY. So if she made a loss of 50,000 JPY, then her take profit in USD, a take loss, I don't know whether it will be a take loss. So her loss in USD, let's put this to be a negative to make the difference that it's a loss. So this is negative 50,000. So her loss will use the now existing form will now use the now existing position to calculate her loss in USD. So that will be, she'll be selling it at 79.0. So we'll take negative 50,000 divided by 79, and then we'll find that taking that 5123 divided by 79.00, we get 632.91 USD. She'll had made that loss 632.91 USD. So that being understood, we can go on to the next bit of it. So having done that, we now have understood leveraging and margins. So let's move to the technical analysis bit. Because the forex market moves so quickly and aggressively, currency pairs are said to be highly trending, with the pairs value often following a pattern of growth or decline. So since it moves aggressively and quickly, it follows some patterns, and they are said to be, and the patterns can be followed and traded. With so many trades going on every day, it's possible to utilize common analytical tools to detect patterns and make predictions. And this is what many people do when they want to do forex for speculation. So technical analysis attempts to predict future price movements by analyzing past price patterns and mathematical indicators. Price charts are the primary platforms used by technical analysts. Price charts. These exchange rates charts show historical price patterns that can be used to help predict possible price events in the future. Some key technical analysis tools and techniques include trends. So there are trends, these are the trends. And then now let's move on to the second bit. The concept of trend refers to a net price movement over time, either to the upside, or to the downside. Currencies tend to trend. Apologies for currencies tend to trend frequently and for fairly prolonged periods of time. Trading with a trend is often advocated because in doing so, the trader is trading with the general net flow of the market. So using this trend, you can predict what happens next. And this is highly encouraged because traders can easily know how the market will go. Support and resistance. Support and resistance represent important characteristics of all financial markets. Support can be considered price floor, while resistance represents a price ceiling. So support, let's see here. Support is this price floor, and resistance is this ceiling. So we at different points we have the support and resistance. Then here we have the breakout. Support and resistance exist because of market memory. Market participants remember certain past price levels or regions where prices stand, and they then act upon these levels in their trading. One can therefore predict enhanced trading activity when prices reach these levels. Support and resistance levels can be used whether traders are trading breakouts of these levels or bounces. So at this point we can see that the market moved in this manner. It had a support at this point and a breakout at this point, and a resistance at this point. So whenever it reached this level, it resisted and moved back down, and then when it hit the support level, it then moved up. So someone can really predict that when at a point a currency is at this point, he or she can predict that when it reaches at this point, she can then buy for it to rise to that certain level. And this helps traders make profits easily. So by knowing where the supports and resistances are, you can know whether to buy or sell. And by knowing that also, you can know whether a currency pair has breaked out of that pattern. Like this point, that's a breakout point. So it has left the trend that was happening here. And moving on to the chart patterns. Chart patterns track price action across time. These patterns can provide key clues as to future potential price movement. So there are different price patterns. Here we can see there's this symmetrical, ascending, descending. Okay, so I see important chart patterns include triangles, flags, pennants, rectangles, wedges, head and shoulders, and double and triple tops and bottoms. Usually a trade entry on a chart pattern is triggered on a breakout of that pattern. It is triggered on a breakout of this pattern. So that's when a trade entry on a chart pattern is triggered. So just to understand this, let me see if, not discussed down below, but generally what I see here is this. You can see these triangle patterns, these types of triangle patterns, that is ascending. So let me just write it down and try showing you. So here we have triangle patterns. So we'll do this. So there's this one that moves like that. Let's say that one. So if we draw a line below it like this, and then we draw another line downward like that, you see this is symmetric. This side and this side looks almost similar. That's symmetric, like it forms such a triangle as this. So that one we call symmetrical. And then let's look at this one. So there's another that moves in this manner. Let's say such a manner. So if you draw a line here and then you draw another line here, you see this one is moving to the top. Let me add here, moving to top. So we can call this one ascending. Anything ascending is anything moving upwards, like Jesus' ascension. Yeah. So then the third pattern, we have this one here. Yep. Let's just move it like that. And then now that one, if you draw a line below and then you draw another from here touching the tops, then you will see that this is moving in this manner downwards. So moving downwards, and that's descending. Yeah. Moving on. And now moving on. But I watched Dylan Page. I'd like to get the aura too. Okay, so moving on. Moving averages. So moving averages are running averages of past price action over a predetermined period of time. These indicators smooth out often choppy price actions and can provide useful indications as to price trends and trend changes. So I think, okay, let's see that. Ask bid. We'll need to do further research on that. These are just highlighted. I guess this book is ending at on page 20, and then the rest 5 of the 5 pages are just questions. I think now they're just highlighting, but we'll need to look for another book to go through this part of important chart patterns, flags, pennant, triangles, rectangles, wedges, head and shoulder, and double and triple tops and bottoms. Okay, moving on. Moving averages are running averages of past price action over a predetermined period of time. These indicators smooth out often choppy price action and can provide useful indications as to price trends and trend changes. So indicators, and okay, here actually I think I can figure out something. So you can see this line, this continuous line, this one here. I think that's the moving averages. So now, like, this guy has made a smooth curve cutting through the prices just to see how the prices move, the averages, how the prices move generally. Yeah, so that's the moving averages. You can use that to know whether when it reaches this point, will it go down or will it continue going up. If you look at it for a longer period of time, you can know where it will be going. So indicators and oscillators. Most of these indicators and oscillators provide indications of possibly overbought and oversold price conditions, as well as trend determination and trading signals. There are many mathematical indicators and oscillators that can be overlaid on a price chart. ADX indicator. So that's one example. ADX indicator. We need another book for that. I'll look for a book and then recommend it for us. Indicators and oscillators, accumulation / distribution volume. Okay, we just need to see what they look like. This like a prerequisite now. And then RSI, overbought / sold. Oh, this was accumulation / distribution. Then this one is overbought / sold. So here we can see this indicator shows the buyer's territory and the seller's territory. So above 50%, above 50, below 50, you can see most people are buying at this point, at around that point. Yeah, and most people sold at these levels. When it passed these marks, then most people sold them. We'll continue looking at that in the next class, in the next video. Fibonacci. Let's see Fibonacci. The Fibonacci sequence is a mathematical construct based on historical mathematical observations that have been adapted to financial market trading. I've had Fibonacci in one of my classes. I do mechanical engineering. So in one of the classes, one of my mathematics classes, I've heard of Fibonacci, and I'll tell you what it is in our next class. So here, Fibonacci trading is based on the golden mean and provides trading ratios that can be used in determining potential target price levels and possible price turning points. Let's increase that, or I'll dedicate one video for Fibonacci, and then we'll understand Fibonacci curves perfectly, then we'll relate it to trading, and then we'll continue with the other videos. I'll do that before I'll make sure to do that before when will be that? Before 27th of this month. Today is 26th. Yeah, I'll do that before today is 25th. I'll do that before 27th. I'll dedicate a video for Fibonacci curves, and then we'll relate it to the market trends and how to trade. Yeah, thank you. So let's go on. Moving on. Ignore that. That's just a message. So candlestick patterns. Candlestick patterns are analysis based on the size. Candlestick patterns are analysis based on the size and alignment of price bars. So these ones here are the price bars. So now these are candlesticks are analysis based on price and based on the price and the sizes of the price bars. So these patterns can be effective in highlighting the conflict between bullish buyers and bearish sellers, and therefore can provide clues as to potential impending price movement. Candlestick patterns, there is going long 3 method information. That one. Go shorting 3 method going long 3 method formation, shorting 3 method formation. In this we can see there is this one uncolored, 2 and then 3 colored in between. This one 3 uncolored in between and 1 colored to the sides. We'll look at that. Going long harami, I don't know whether it's haramai. Okay, going long haramai. So this one seems to be going long haramai and shorting haramai. Well, we'll see that. And then going long haramai cross and shorting haramai cross. Shooting star, and then there's spinning tops, dark cloud cover, high low sequence, open to close. Okay, that one is not well expounded on this book, so we'll move to another book. I'll look for another book and then suggest to us what we'll be going through with that book. So moving on to the next part, fundamental analysis. Fundamental analysis involves the analysis of influences that may cause a currency pair to move higher or lower. It involves the analysis of influences that may cause a currency pair to move higher or lower. Generally speaking, a currency pair will move higher if the economic influences of the base currency are more positive or a relative basis than the economic influences of the quote or term currency. Now I guess this is whereby you predict the movement of the currency. I've seen people doing that. I've seen it in the media, people predicting the currency movement according to right now we are waiting for the US elections 2024 I mean. It will be happening in December this year. So many people are trying to predict movement of stocks and prices and commodities and other currencies relative to how the outcome of the election may be. And they also do that with influences of how the campaigns are currently happening. And things like assassination attempts of Donald Trump and other parts or segments of the speeches that he gives during his campaigns are used to track down and try to tell where the market will be going. So the fundamental influences, there are many economic factors that may cause an economic bias, which then affects the value of currency pairs, such as GDP, interest rates, inflation, employment, retail sales, trade balance, current account, gold prices, commodity prices, even currency values, fiscal policy, central bank policy, and stock prices. All those affect currency levels. So if you want to do fundamental analysis, then you may very much like to know more about these fiscal policies, stock prices, gold prices, commodity prices, even currency values. Pure fundamental traders tend to focus on the longer term trends of economies. Those judgments are typically derived by analyzing the trends of economic data. If the trend suggests economic growth of a nation, this will positively affect its currency. If the trend suggests economic decline, this would negatively affect its currency. Economic data is released on a scheduled basis. So let's move on to the creating a trading plan. I guess this is the last bit of this book, which we'll be discussing here, because the rest is information about the company and maybe quizzes on yourself. We won't be going through this, but later on we'll be looking at another book for things that we may have been highlighted here but not expounded greatly. So the trading plan. Creating a solid trading plan is one of the keys to becoming a successful trader. By detailing all aspects By detailing all aspects of your trading in a comprehensive plan, you can eliminate ambiguity and potentially negative trading behaviors. Many people fail because of negative trading behaviors. Like, for example, you say that I'm buying this now let's look at the example of Mary here. Mary bought at 79.50 and at 80 she was content. So some people, you'll find that at 80 they are not yet content, and thereby they had a target of, let's say, 80.50, but then they wait for the price to move to 80.50. The price moves to that bit, but then they are not yet content. They say, let it then reach 90 and then I'll sell. And then the price goes up and then it starts shooting down. So you'll find that when it starts shooting down, they'll see they are making losses and then maybe cash out or sell at around 73, that thereby making a very, very great loss. So you need to develop your trading plan to ensure that you trade successfully. You don't need to have negative trading behaviors, such as, let's call it, you don't need to have trading hunger, or you don't need to be selfish, and you should have good trading behaviors. They call it positive trading behaviors. That's just what I've said, because here it's written negative trading behaviors. A plan for trading is similar to a plan for any other business. Sure. It's essential to ensure that the business owner or trader sticks with a well thought out and tested approach to growing the business while minimizing risk. So we need to get our trading plan, and then it should be well thought and a tested approach. We don't need to be trying out new things. You can try out, but for a beginner, it's easier to follow an already proven approach instead of making your own. You cannot really afford making those losses when you are beginning to trade, when you have limited amount of money. So elements of an effective trading plan should include all of the most important aspects of the trading process. This should include, at the very least, amount of starting capital. So elements of a trading plan: amount of starting capital to be used for trading, primary lot size and leverage used, primary currency pairs traded, maximum percentage of trading capital, risk on each trade. So the maximum you risk on each trade, reward to risk ratio target, realistic daily or weekly and monthly profit goals. So you have to have your profit goals, reward to risk ratio lined out well, maximum percentage of trading capital, risk on each trade, amount of starting capital, you also need to know that, and primary lot size and leverage used. All that you have to keep in mind before you start, to ensure that you have good plan and you keep yourself in line. When you're making lots of losses, you sit down and wait a moment, pause and re-strategize. Specific daily and weekly, monthly loss limits. So you need to have your profit goals and loss limits, and loss at which a trader stops trading for the given period. So whereby you make some losses and then you decide, no, let's wait and we'll try again, let's re-strategize. Specific trade entry criteria according to the tested trading strategies, specific trade exit criteria, stop losses, profit limits, and or manual exits, according to the tested trading strategy methods for managing open trades, methods for managing open trades. And as part of this plan, they should also keep a date. The traders should also keep a detailed journal of all trades with reasons for entries, exits, so that there is an ongoing assessment of exactly how well the trading plan was followed. So to keeping a detailed journal, I have an app that I can recommend to you. Well, I'm not promoting anything, I'm just telling you what can help you. This app is called My Diary. You can find it in Play Store or maybe your preferred app store. It's called My Journal, and in there you can attach photos, you can attach text, everything about what's going on. So this one can help us really well. You can photo your exit and your entries and write the reasons for that, and the take profits and every detail of what is going on as you trade. Well, catch up for the next video. We'll be going through another book of perfect choosing, and well, I'll tell you before we start on that book. See you next time. Bye.